Hey guys, I'm back, but today I'm going to talk to you guys about vocab, right? The vocab you guys are going to run into, the vocabulary that you will run into in the financial markets. So just like any industry out there, right? If you look at engineering, you look at medicine, you look at lawyers, right? They all have their own vocabulary, they all have their own slang, they all have their own jargon that each person in that community uses to communicate. And what that vocabulary really does to those outside is really create this barrier. It creates this wall. It creates alienation of the people who don't understand what's being said. And it's something that I don't necessarily agree with, but is an integral part of each of those communities. Like, I don't see any time in the near future where any of us will go to our doctor and ever understand what the diagnosis means before they sit down and explain it to us, because they use some fancy terminology to mean something like a sprained ankle, right? Same way doctors do that, financial people or people in the financial markets use all these crazy terms to mean things that could be explained very simply, but they use these crazy terms. So here I just want to break down some of them so you're more familiar with these. It'll give you a better jump start when you're, say, if you're researching something out there, you'll run into them all the time, but you'll actually understand what's trying to be conveyed, and it won't cause this frustration that a lot of people feel when they're first entering in the financial markets, that there's all this vocabulary that they don't understand, they don't feel like they will understand, when in reality it's pretty simple once you learn it. So the first term I want to break down for you guys is bullish. So bullish, I have no idea, to be honest, the origin of this term or why it's used or where the inverse of it comes from. However, I see it all the time. Bullish means like an upward market bias, right? So if I own stocks, right, that would be a bullish trade. It would be a bullish position, and that position or that trade makes money as stock prices rise, right? So that would be an example of like up. I think it really just means up if you break it down, right? If I have a bullish portfolio, I have a bunch of different trades on in my portfolio that profit as the overall stock market rises in price, right? So bullish really just means upward movement, upward price action. It's used in many different ways, but you'll see it everywhere. And the way I remember this, because this is kind of abstract, if you've never heard this before, you're like, why do they use bullish to mean up? I don't know, but they do. But the way I remember these crazy little terms is I just think of a bull, right? It has two horns on its head, right? And say if it's charging at you, the way it's going to try to get you is going to be like whack. It's trying to like poke its horns up and gouge you. Well, that's how it's making its money, right? If you're a bull, if you have a bullish trade on, you're making money as the stock prices rise, or whatever that underlying is, right? Whatever that asset is as the price of it rises. So that's how I remember that one. Again, I don't know where these came from, but you'll see them everywhere. The next one is bearish. It's actually the inverse of bullish. So where bullish meant up or upward movement, you're going to find bearish meaning down or downward movement, right? So if I have a bearish trade on, it's a trade that's profiting from downward price movement. If I have a bearish market outlook, that would mean I see price action in the overall market heading downward in the future. If I have a bearish portfolio, that means I've positioned myself in a way to profit from downward movement in price, right? So you'll see it all over the place, and a lot of times it's like this never-ending battle, the bulls versus the bears, up versus down. And you'll see things like if you have a really big up day, you're like, the bulls took it to the bears today, or the inverse, really big down day, the bears are taking the bulls, right? And again, I have these little gimmicky ways to remember things, but the way I remember bearish is I just think of a bear standing on its hind legs, right? And it takes its claw and it's swiping at you, right? He's making money as the stock price is falling or the asset is falling in price. So that's how I remember those two: bullish, bearish, up, down. You'll see them everywhere. That's actually, there's a big bull outside the New York Stock Exchange, and it's really a part of the culture. It's craziness, but you'll see it everywhere. The next terms you'll see a lot of is long and short. You'll find a lot of similarities between bullish, bearish, and long and short. Long really means to buy or you own, so you've already bought. Let's just use stock for an example. So say if you're long stock, that means you've bought stock, right? And stock, if you own stock, in that situation you profit when stock price moves up in value. So again, if you have if a long stock trade, that means you think the price is going up, so that actually is a bullish trade. So you can see where these two things kind of very similar in nature, but you can also buy assets or derivatives rather that increase in value as stock prices fall. So that's where it'll get maybe a little confusing. We'll go over that later, but long really means to buy, but most things when you buy them you profit from upward movement in price. So again, you could see it used in that fashion, like a long portfolio. That would pretty much mean that you own a lot of things and you're going to profit from an upward movement in price. So you have a bullish bias when you have a long portfolio. You could even say it's a bullish portfolio. So you can see where those two are very similar. Short is just the inverse of long. It means to sell, or you have sold. One of the more difficult concepts you'll run into in investing, at least it was for me in the beginning, was something called shorting the market, or like shorting stock, right? It's actually the opposite of getting long. So getting short is the opposite of getting long. Getting long is buying stock to start out your trade, whereas getting short or shorting stock is selling stock to start your trade. So you're actually selling something you don't own. And there's this whole big back-end process that allows that to happen, that really just stems from the nature of how brokers make their money, which is through commissions when you place the trade. So if they have a client of theirs that owns a lot of stocks, that never trades them actively, right? He just buys and holds. He's a very passive type investor. He bought 1,000 shares of Apple, let's just say, or owns 1,000 shares of Apple, and I want to short Apple. The brokers, being the opportunistic people that they are, they leverage those assets they have in their grasps, just like a bank leverages the deposits that you put in it to make loans. They leverage these assets and loan them to short sellers so that they can then go out and sell these assets into the marketplace, and then when the stock price hopefully falls, you buy it back at a lower price, therefore locking in a profit, right? So if you sold it at $10, you buy it back at $8, you keep the $2 differential in the middle. So that's shorting. Again, it might take a little getting used to. Again, you're selling something you don't own. You're selling to start the trade, and it'll show up as a negative amount of shares in your account. And just know it's out there. It's a second way to make money. So not only can you buy low, sell high, but now you can sell high, buy low. So there's two options you have there. But again, short really just means to sell. So if you can sell options, you're short options. If you have a short portfolio, again, this is where you'll see the similarities between short and bearish. A short portfolio is generally going to profit from downward price action or downward movement in price action. So again, you could say you have a bearish bias when you have a short portfolio. Again, you'll see those four terms used very much in unison or together, in many different combinations and ways. But long means buy or bought short means sell or sold. The next thing I want to just break down for you guys is a stock. Most people know what a stock is, but possibly some of you don't. It's really just a certificate of ownership of a company, right? And I have one here. Oh, totally forgot about this. But they used to be actual. Hi, wait, can you see this? It actually used to be like an actual certificate. You can see certificate of stock. So they used to be physical certificates. That was given to me when I was a baby. But nowadays everything's so electronic that it's just really numbers in your account. But stock is certificate of ownership in a company, right? So when a company wants to generate they want to generate capital, and they come to Wall Street for capital in an alternative way, right? Other than getting a loan at the bank, they have two choices, right? They can either sell little bits and pieces of their company out in the form of stock, like we're talking about, or they can sell bonds, which is really just taking loans from investors instead of the bank. But say if I had a company, XYZ company, I go to Wall Street, the company has 100 shares. Now, no company going public ever just has 100 shares, but keeping the example really simple here, you have 100 shares. I would definitely keep 51 for sure, so I maintain controlling interest. But besides that, so I sell 49 out into the public, and you buy one. Now you are the proud owner of 1% of XYZ company, the assets, everything. So that's what it represents. That's what it is. And that's why if you ever hear about dividends, like you'll hear people like high dividend paying stocks. Well, dividends are profit sharing tools, right? So because you own little bits and pieces of the company, right, you actually own part of the company, you share in the profit that it makes. So when it does very, very well and it makes a lot of money, you make money through dividends because they give you part of that profit. So again, it's really just a certificate of ownership in a company, and they're cool stuff. Most people know about the stock market, and it's a fun place. But the next thing I'm going to talk about is mutual funds. Mutual funds, they were invented as a way to get diversification more easily than you having to do it yourself, right? Most people, well, okay, I won't say most people, but some people in America like to take the easy route when it comes to certain situations, especially when it comes to finance, I'm finding. So instead of having to figure out how you're going to diversify your portfolio to mitigate some risk, right? Because say if you're 100% invested in one stock, if that stock or that company goes bankrupt, you lose all your money, right? Whereas if you were invested in 10 stocks and one of those stocks went bankrupt, now only 1/10 of your investment is lost, not all of it. Now, diversification isn't the end all be all. It doesn't solve all problems. You still face systemic risk and a bunch of other things that we'll go into later, but that's why they were invented. They were invented as an easy way for the consumer to get diversification, right? Because you buy one mutual fund, but that one mutual fund would then, in this example, own those 10 stocks. So you're getting diversified because you have ownership of the 10 stocks, yet you only had to buy one mutual fund. You didn't have to go out there and buy each stock separately and individually. And it was also a way for people to have limited capital to get that type of diversification, right? Because say if you only had $100, it'd be hard to go out and buy shares in 10 different companies with only like $100, unless they're really cheap stocks. But if you wanted to get that, you could get that type of diversification in a mutual fund if you own one share of a mutual fund, and maybe you own partial shares of each, like the equivalents of partial shares of each of the companies, because the mutual fund's really just a pool of money, so that everybody throws their money in the bucket, then you own that percentage of the bucket, and that bucket is invested in different things, right? So you can see how it was invented to get diversification and really help those with limited capital achieve diversification. However, the mutual fund industry is very much taken on a life of its own. because the average American consumer is quite, they like the idea of somebody else doing it for them. And my biggest, I guess, beef I have with mutual funds is the fees they charge. They charge a lot of different fees. I don't want to go into everything, but you have things like whether it's a front load, back load, no load fund, where a load is the sales commission that the advisor gets when they sell you into the mutual fund. You have hidden fees. Fees even within the expense ratio, which is how much it costs to manage it per year, right? Because it owns all these different things. There's somebody who has to manage those things it owns, right? Whether that may be bonds or stock or whatever it may be, commodities. Somebody has to manage that, and they charge a fee in order to have that management, right? But the problem is with having high fees, which most mutual funds do have, is that you run into the problem of compounding cost, which is really the inverse of compounding interest, right? So like the most powerful concept that we have in investing is compounding interest, right? Your gains are making gains, right? Whereas compounding cost is that cost, those fees that you're paying really eat away at your potential returns you can make over time, because you don't get the benefit of compounding interest, right? So those fees are suddenly eating up more and more and more of what you could have made, right? So I'm an advocate for things that have very low expense ratios, low fees, and you'll find those in more passive mutual funds. Again, I would look to ETFs, which even have lower expense ratios. That's actually the next thing on our list. ETFs are exchange traded funds. They are pretty much the same thing as a mutual fund, right? It's a basket of assets, right? Whether that be stock, bonds, commodities, whatever it is. It's a basket. So you get the diversification you get of a mutual fund. However, there are some key distinctions that I'd like to make. And I have this cool little website. This is Vanguard. They're a mutual fund company, but I figured I'll just use some graphics so you guys don't have to just stare at me the entire video. But you can see how ETFs and mutual funds are the same in that they have diversification and that less risk through diversification, and somebody manages them. Now, if it's a passive fund, mutual fund versus ETF, you'll find that the fees are very, very minimal because they're not actively trading it. Whereas an active fund is where you have some money manager trying to outperform a benchmark, right? So say the S&P 500, which we're getting to in subsequent videos, but it's pretty much a benchmark of the marketplace. How much did the stock market make versus how much did the fund make? So if in a actively managed fund, you'll see those people trying to outperform, and they outperform through moving money in different areas. They're constantly in and out of things, and in doing so, they create more costs and usually underperform due to the costs that they pass on to their investors, right? Because they're constantly in and out, they're constantly moving things, they have to charge higher fees, and because of the fees they charge, they underperform their benchmarks. So I'm an advocate personally of a more passive type of funds. If you are looking at mutual funds, I'm gonna break down the differences here and recommend ETFs, but you do what you want. ETFs. So one of the big differences between ETFs and mutual funds is that you can see here ETFs trade on all the major stock exchanges, and they trade during the day, and their prices fluctuate through the day just like stocks. So they trade like a stock. You can trade during normal market hours, whereas mutual funds are priced once per day after the market closes. So say if there was like Black Monday, right? Or like there's this big event, and say you even had like insider information somehow. I don't know. So say you're best friends with Warren Buffett. He calls you up, say you want to sell everything you own right now because the market's going to be 10% lower by the end of the day. Something like that. You can't get out in a mutual fund. You are literally stuck in there until the market closes so they can price the assets that are in that bucket, or because they properly price the bucket after the asset prices stop fluctuating. And that's why they have to wait till the end of the day. Versus an ETF, you can get that same exposure, same diversification, yet you can get out whenever the heck you want to get out. You can get in and out during the day. You can even trade it during the day, which is kind of fun. But that's one major difference. Another major difference is you'll find that the costs, right? So I talked about these fees that a lot of mutual funds have. Now, Vanguard is pretty cool in that they have very, very low fees in the mutual fund industry. They were the first fund invented to be owned by the clients, not by like the corporate people who are just trying to make a profit. This is the dude, John Bogle. He was trying to look for a better way to make a better mutual fund company. I guess he did. So they have pretty low fees, but the problem with most mutual funds is they have that higher expense ratio. They have those loads on them that you won't find in an ETF, right? So if they're practically the same thing, yet you're charged more for one, why would you buy it? You know, and one of the biggest reasons I would advocate people look towards ETFs is because you can trade options on ETFs, not on mutual funds, right? And options give you the ability to both cash flow and protect your investment. So you actually can mitigate more downside risk than you can through diversification through the use of options, as well as create monthly cash flow with the asset. Just like renting a house, you can kind of rent ETFs. But that's farther down the line, but I'm saying you have access to doing that kind of stuff in an ETF. You can in a mutual fund, right? So if somebody was like super dead set, right? So say like for some reason they came to me and they're like, my life depends on me buying a mutual fund. Number one, I wouldn't understand what they're trying to, I don't know. I wouldn't understand it. But if somebody had to buy a mutual fund, right? I would personally look towards Vanguard Admiral shares, right? So not only does Vanguard have pretty low fees in terms of the industry, but their Admiral shares have even lower fees than their typical mutual funds. You can see 52% lower than their standard funds and 86% lower than the industry average. The one caveat with these Admiral shares is that you do have to have a substantial amount of money in them. You can see you must meet and maintain a minimum investment of $10,000 in most index funds, $50,000 in most actively managed funds. So you can see you need more capital in there in order to participate in those funds. But I would say probably through my research up until this point, that's probably the best mutual fund you could find. However, again, if I had the choice, mutual fund ETF, I'd always default to ETFs, right? And it's just like it boils down to things like, right? So mutual funds have all these hidden fees. One of them, it's included in the expense ratio, is the 12B1 fee, right? It's a fee they literally charge the people in the fund, that they then, the money that's made from charging that fee, which is usually between 0.25% to 1%. I think it's actually capped at 1%. They use that money to then go advertise. So they're literally charging you their advertising dollars to be in the fund, right? So then they can go out and advertise and get more people in the fund. I don't know. I don't agree with it. I don't agree with the industry. I understand the industry. I don't think that they're doing the best thing for the investor, personally. Just my humble opinion. But anyways, that was breaking down some of the different types of investments, or terminology rather, that you're going to find. This video is running rather long, so I'm going to cut it off right here. I'm going to do a part 2 in a minute here, so you guys will see that coming out shortly. But until then, I'll talk to you guys later.